So the first week of trading has just wrapped up for Instacart stock, who IPO'd earlier this week. And by the way, that was following another very high profile IPO of the chip company ARM Holdings only the week prior. Well, both stocks have been talked about a lot. Both are getting a little divisive among investors. I mean, there's a lot of people out there calling these the next megatrend tech stocks that they think will skyrocket in the future, while others consider them to be overvalued or overhyped. And of course, there's more reasonable minded people somewhere in the middle too. But regardless, I actually gave my opinion on ARM stock last week. So this time, we're going to do the same thing except for Instacart. And in today's video, we're going to be focusing on their business, their future potential, the stock price post IPO, what their valuation looks like. Is it cheap? Is it expensive? And of course, as always, I'll let you know if I'd consider buying Instacart stock myself anytime soon as a long-term investment. So it's going to be a fun one. Sit back and relax. We got a few things to run through here. Let's not waste any time. Let's go ahead and just jump straight into it. All right, now most of you will recognize Instacart for being one of the biggest grocery delivery companies to really rise up in popularity, especially during the pandemic, where you can shop online through their app for groceries to be delivered from local stores right to your doorstep for an added fee. I don't personally use it myself because I don't know. I actually enjoy shopping physically at stores. And whenever I'm too lazy or want a better deal online, I usually just head over to Amazon instead. However, I do admit that I see the appeal of Instacart, and I actually have several friends who use the service almost exclusively for all of their grocery shopping needs. A couple of them even signed up for the subscription plan called Instacart Plus, which gives you free delivery, lower service fees, and a few other perks for the price of around $10 a month, which I actually think is pretty affordable. I mean, even most video streaming services cost more than that. And by the way, Instacart has also expanded into selling not just groceries, but also technologies like computers and TVs. They sell home and garden, pet supplies, office supplies, and all kinds of other general home goods that you can typically buy from your local stores. And I think that's a very attractive proposition for people that can afford the added fees and would prefer to save time rather than money. As such, the online grocery market has been growing by tens of billions of dollars every year and should reach about $250 billion in just about a year from now, just in the United States alone. And yet, only less than 10% of grocery shopping was even done online up until last year. So there should still be plenty of room for growth in this market well into the future. Okay, so all of that sounds great, right? But how is Instacart specifically performing in this market themselves? Well, they're actually doing extremely well. In fact, as a third-party grocery deliverer, they're ranked number one in America at a whopping 70% market share. The next closest is their rival DoorDash at only 10% by comparison. However, that's not really the metric that you should be looking at. The real competition, at least in my opinion, is from first-party grocers or companies. And when you include those, Instacart's market share drops all the way down to just 21%. And I don't personally see a gigantic barrier to entry here either. I do think Instacart has a strong brand and a simple business model to keep customers happy, but I'd still be a little worried about more stores offering their own delivery services in the future. Still, as it stands right now, I can't really argue with the results. I mean, you're talking about a fifth of the entire market here controlled by Instacart. That's pretty damn impressive considering the only two companies ahead of them are gigantic behemoths in Walmart and Amazon, which are just barely higher. And other giants like Kroger, Target, Albertsons, and more are only a fraction of the size of Instacart. Another thing I like about their business model is that it doesn't just rely on grocery sales alone. Instacart has really three main parts to their business, which are the third-party marketplace, the enterprise platform, and the digital advertising business. Now, the third-party marketplace is that main app that consumers use. And again, they're doing a great job of competing there with huge market share. And over 85% of all grocers in America are already listed on the app, which is really impressive. However, I think the other two segments are just as important for the future, as they remind me of other high-profile e-commerce giants like Shopify and even Amazon. See, Shopify helps other businesses set up easy-to-use online shopping platforms that are powered through Shopify, and in many ways, that's really disrupted a lot of retail, which is why Shopify stock has skyrocketed by almost 2,000% since going public about 8 years ago. Well, Instacart is doing something very similar, except it's specifically targeted towards grocers and other local retailers that want to set up an e-commerce platform with a delivery service, which Instacart helps them set up and run. And when looking at digital advertising, they're doing something very similar here to Amazon as well. See, as the largest online shopping marketplace, Amazon has used their digital real estate to advertise certain brands that pay extra to stand out over the competition. Well, as the biggest grocery marketplace, Instacart is doing the same exact thing, which has seen so much success, in fact, that it already accounts for nearly 30% of all their sales. That's huge because advertising is actually very high margin, and it's one of the reasons why they've already started to turn a GAAP net income profit while other rivals like Uber and DoorDash continue to bleed on the bottom line. Which probably makes this a good time now to transition over to the second part of our video, where we're going to discuss the financials, the stock's valuation, and whether or not I think it's a good investment at today's price for the long term. So let's go ahead and cover that now, and I'll finish up with my overall conclusion on all of this. Well, as you would expect, sales exploded during the pandemic, rising by almost 600% in 2020, and yet they still managed to grow them by almost 30% and 40% in each of the next 2 years respectively too. That's pretty damn impressive. I mean, I'd be fine with seeing a correction there after blowing up by so much, but no, in fact, they're still growing. Now, the one concern that I do see right away though is that their orders growth, basically the number of transactions, fell flat in the first half of this year. Now, it's not a huge concern because orders more than tripled during the pandemic, so a small correction here is I would consider generally fine, and it also proves the point I made earlier of how important it is for them to diversify into enterprise and advertising, because total sales still grew by over 30% in that period despite the flat order numbers. But it's still not really a great sign, and going forward we definitely want to see order numbers climb, so that is something to be keeping a very close eye on. Now, on the profitability side of things, like I said before, the higher margin advertisements helped them reach GAAP profitability last year by hundreds of millions of dollars. And again, despite the flat order numbers, their net income still grew in the trailing 12 months by a whopping 74% over 2022 numbers. So for now, it does look like the profits are stable, but if I was investing in the stock, this is another thing that I would be keeping a very close eye on going forward to see if they can keep growing these profits, consistently in future years. Speaking of the stock though, it technically IPO'd at $30 a share, setting the valuation at about $10 billion, which we'll come back to in just a second. However, the stock immediately shot up to over $40 on the first day of trading before crashing right back down to that exact $30 price in the following days. So with that in mind, let's see how the valuation looks now and how expensive the stock is. Well, according to Seeking Alpha, the current market cap is around $9.3 billion, which, by the way, is gigantically lower than the nearly $40 billion valuation that they had in the private markets during the height of the pandemic, which also made them the second most valued unicorn in America, only behind Elon Musk's SpaceX. By the way, the term unicorn just means a private company or startup that is worth over $1 billion. So they were like the second most valued one in America. Anyway, the crash in value does make some sense given how many tech companies from the pandemic lockdown era have really seen their stocks get absolutely destroyed coming off of the pandemic. But yeah, for those venture capital backers and investors that bought into the hype at the very top, they'd be down over 75% right now, which is pretty crazy. Now, I don't personally think that Instacart will be returning to those extraordinary levels anytime soon. I mean, anything is possible, and if another pandemic hits, definitely it could. But at today's lower level, I think that the price is actually pretty fair. Now, I know that these aren't perfect direct comparisons, but I made a chart here with some of their biggest rivals in the space that offer at least some type of similar service. And you can see that based on last year's profits, Instacart has a PE ratio of only 22. And if we convert that into the last 12 months of earnings, it gets even cheaper to just 13. And that's not only lower than the sector, but it's even cheaper than any of the other stocks on here. And mind you, DoorDash and Uber don't even have profits yet. Now, on a sales basis, it does get much more competitive, with Instacart being the second most expensive, only behind DoorDash based on 2022 sales, which doesn't get much better based on trailing 12 months either. Even giants like Amazon, Walmart, and Target are all significantly cheaper, while the sector median is also less than a third of Instacart's price to sales ratio. But again, sales are not what I would actually be focusing on here. I think going forward, if they're able to keep growing their profits like they are right now, then the stock's valuation is actually looking pretty cheap right now at today's prices. And I think there's just a lot to like overall about Instacart. I mean, they've got a solid brand, solid value proposition for customers, especially with Instacart Plus. I think they're doing everything the right way, just like they should. And I could definitely see them become much larger over time. And so as a small kind of speculative position, I don't think it's too crazy at all to be taking a small chance on it. I think it's more than reasonable as a small kind of speculative play for the future. However, with that said, I'm actually still not buying this stock. And there's two primary reasons for that. Number one is the flat orders growth. I just can't get over it. I get that we're coming off the pandemic. It might just be a small speed bump for now, but I'd rather wait a while and see how consistent their growth is. It's very rare that I buy into a stock so close to an IPO. I like to wait a little bit more and see more consistent growth. I don't want to buy into something where the growth is still a little questionable. And if it is, then I need to not just like the business, I need to be in love with their business and love their future potential. And it has to be exposure to a market that I don't already have. Which brings me to the second reason why I'm not buying, and that's because I already own Amazon stock, which, look, I get that they're not exactly the same type of company. They're not doing exactly the same things right now. But Amazon does do very similar things, and I don't think they acquired Whole Foods for nothing. I do think they have huge ambitions in this space, and they certainly have all the money they'll ever need to just throw at the problem and gain market share in the future. And we know how ambitious Amazon is. We know that they're always looking to enter new markets and do new things. So I wouldn't be surprised at all if in the future Amazon gives me the same type of exposure to all the things that Instacart can do right now. And I'm not saying that Amazon will completely wipe out Instacart. Market may very well be large enough to support multiple players, and certainly both companies can thrive in it. But in today's economy, I'd rather be investing my money, instead of putting it into a riskier stock so close to the IPO, I'd rather be putting it into Amazon, who I feel is much larger, safer, and more diversified. And look, I get that Instacart has more gains potential because it's a smaller company and smaller stock, but they also have more loss potential too. In other words, they're a bit riskier. And so I would just feel more comfortable investing in Amazon instead. And by the way, I also get that Instacart might look like a cheaper stock from a valuation standpoint on a PE ratio, but that's because Amazon doesn't even try to be profitable right now. I mean, if you look at Amazon's PE ratio, trailing, it's over 100. Forward, it's less than 50. That means it gets cut in half in a year. That's because Amazon, if they ever try to be profitable, their earnings can skyrocket and that valuation can come way down. It's really not as expensive as people like to think or say that Amazon is. I actually think it's a pretty good stock to be investing in long term. So in today's economy, I'd rather be investing in something a little safer like Amazon, but Instacart is still very interesting. I will be keeping a very close eye on it. I just want to see them, I want to see how they perform over a longer period of time for now, rather than buying into this IPO right away and taking a bigger chance on it. But hey, those are just my thoughts, my feelings. What do you all think? I'd love to hear your thoughts down in the comment section. Are you buying Instacart stock? Do you agree or disagree with anything I said? Thanks again for stopping by, my friends. I hope you enjoyed the video, and I will catch you in the next video. Take care, everybody. Bye-bye.